about 5 minutes out from the opening bell as we wrap up the first half of 2021. Joining us now to talk about the sectors that have been on the move in the first half of the year and how to think about the second half is Jill Carey-Hall. She's a senior U.S. equity strategist over at Bank of America Global Research. Jill, thanks for jumping on once again. So you guys have a couple notes that I think are interesting in how you're trying to define or redefine or suss out maybe the market's definition of a couple ideas. Let's start with quality, which everyone likes to say, we're buying quality, we want to own quality names. How are you guys thinking about what stocks fit into that definition as we sit here today at the end of the first half of 21?
Right. Thanks for having me. And it's a great question because there's a lot of ways you could define quality. And what we found is that there's not necessarily always overlap between what's high quality and what's more defensive, low beta. High quality stocks can actually be cyclical. So some of the highest quality sectors within the S&P 500 are actually some of the higher beta sectors in terms of, financials, in terms of industrials, and then obviously some more defensive areas like consumer staples. But traditional finance tells you that you should pay a premium for safety and take a discount for risk. But high quality stocks have actually been trading at a discount to riskier, lower quality stocks for decades now. And a lot of that is really due to all the injections we've seen of fiscal and monetary stimulus. So we think if we are at peak stimulus, that we could be in a backdrop that high quality stocks could finally start to re-rate again relative to their low quality counterparts.
Jill, if I was building a portfolio from scratch today, where can I find the highest quality, cheapest stocks in the market? What sectors?
So we'll define quality by earnings stability. And, as I mentioned, some of the more cyclical areas, you can find a number of high quality stocks in terms of industrials, tech, financials. So financials is an area that has grown much higher quality since the financial crisis. It's really cleaned up its balance sheets. It's a sector that has seen much more stable earnings. It's now returning cash to shareholders. So financials is one of our top overweight sectors, a sector that we like within both large and small caps right now. So we would overweight financials as a quality sector.
Jill, something I had to chuckle at in your notes, you called industrials chicken energy. Outline that for us a little bit and talk us through maybe what we've seen in energy and industrials in the first half of the year, because we were pulling some data over here on the first half performance. And man, you have really had a nice year if you're overweight energy.
Yes, so we've liked both energy and industrials, but we've preferred overweighting CapEx beneficiaries over consumption beneficiaries. We do expect a CapEx rebound as corporates start to spend more. The industrial sector is one that compared to energy has grown more expensive now. When you think about many of the ESG or environmental, social, and governance funds, they've kind of purged their holdings of energy stocks as a traditionally more dirty sector. But that's an area that we see could potentially improve a lot on ESG as some of these energy companies increasingly improve and become more green. And it's a lot cheaper than industrials right now. So we actually lowered industrials from an overweight to a market weight recently. Energy can certainly be a more volatile sector, but certainly from a valuation perspective, there's a lot of opportunity right now. We still like CapEx exposed sectors over consumption exposed sectors. So we had downgraded the consumer discretionary sector to underweight because as inflation has picked up, wage inflation has been a rising concern. And the consumer discretionary sector is one that has, very high labor intensity, especially in some of the traditional, restaurants, retailers, hotels, very high levels of employees relative to sales. So as wages rise, that's an area that could be more at risk.
And in your latest note, you sound a little more upbeat on the real estate sector compared to where you were, but the home builder stocks, the past few months, they haven't been doing a whole heck of a lot. I've really been lagging here. Do you expect these stocks to ultimately re-rate?
So for the real estate sector, which is, mostly equity REITs, that's a sector that is largely still underweight by fund managers. They've been increasing their exposure, but still relatively underowned by mutual funds. And the fundamentals have been improving. It's one where if we're expecting an environment that CapEx picks up, a lot of REITs are exposed to this, industrial REITs, towers. And these are areas that in many cases have secular growth opportunities. There's exposure to data centers within the REIT sector. So, that's a sector that fundamentally has started to look better positioned recently. Some of the home builder exposed stocks are actually within the consumer sectors.
All right, we're about 10 seconds out from the opening bell here on this Wednesday morning. We see Clear ringing the bell down there on the floor of the New York Stock Exchange. Clear, a brand that perhaps people had forgotten about in the pandemic, but now that we are seeing just unbelievable traffic at airports over the last few weeks and into the holiday week, and expected to be the biggest since 2019. Certainly your Clear membership likely making things, if you have one, a little bit easier there where it is offered. I know they got one at JFK. I think there's one out at LGA. I have not sprung for the $95 a year, whatever it is. But maybe sometime, Sozzi, I'll let them scan my eyeballs so I can get through TSA a little bit more quickly. Jill, finally, before we let you go, I just want to think a little bit as we go forward here into the second half of the year, we get into an earnings period, and just what conversations have been like for you guys with what portfolio managers are most concerned about, what they see as the biggest risk. Is it still inflation? Are we talking about the Fed? Where are the heads out of the clients that you're speaking with as we head into the back half of the year?
Look, I think inflation is still a top concern. Last earnings season, we saw mentions of inflation just skyrocket in terms of, kind of across the board companies talking about this more. A lot of it had still been on the transport and other costs, and not as much on the labor side. But I think that's where, you're starting to see more concern as wages rise, and we've seen labor shortages and a lot of these types of issues. So, that's where we're more cautious on some of the highly labor exposed areas like consumer discretionary. And then that was one of the reasons we lowered industrials to a market weight, is that, parts of industrials are very exposed to labor as well. So I think that's something we'll continue to watch as second quarter earnings season progresses. We'll be watching margins, because companies were largely able to price through. So far, so good there. But I think that's going to be a key question going forward in terms of the margin outlook for companies.
All right, Jill Carey-Hall, Senior U.S. Equity Strategist and Head of U.S. Mid-Cap Strategy over at Bank of America Global Research. Jill, always a pleasure. Thanks for jumping on, and I know we'll talk soon.
Thanks.